Hello and welcome to the Financial Management module on Organizing Your Financial Management System. This module is part of a series of e-learning modules designed to foster and develop the financial management skills of people working in global health. Each module will offer an opportunity to learn from experienced managers and to engage in learning activities that are designed to apply the skills and concepts to your own professional setting. This e-learning module was produced by the University of Washington Department of Global Health, based on content from the Financial Management Essentials Handbook developed by Mango. Mango is an award-winning UK charity whose mission is to strengthen the financial management and accountability of non-governmental organizations around the world by providing innovative, high-quality in-person trainings, consultancy and recruitment services. This module provides an overview of the basic content, but not the full experience of attending one of Mango's practical and participatory training courses, where the motto is taking the fear out of finance. A library of Mango's own publications, as well as information about their services and their open training program, can be found at the Mango website. We encourage you to visit this resource of information on financial management and accountability. When you have completed this lesson, you'll be able to explain why it is important to design financial systems that are right for your organization. Describe the two branches of accounting and understand the importance of organizing accounts using key tools such as the chart of accounts and project cost centers. You'll also be able to define the different types of costs and understand the various policies and procedures that are needed to guide operations and avoid misunderstandings. Finally, you will be able to identify the key components of a finance manual, which serves as a reference for program staff to ensure strong financial planning and management. The resources of an organization, such as staff and volunteers, vehicles, property and money, have to be coordinated to ensure implementation of the overall plan. It needs to be clear what activities and responsibilities are to be undertaken, when, and by whom. Let's begin by discussing systems design and some of the key tools that will help to get your systems organized. It is important to note that not-for-profit organizations are quite different from commercial organizations, and therefore financial systems have to be adapted to meet these needs and resources. The key tools to help get your systems organized include an organization chart and job descriptions of staff, a financial accounts structure, including a chart of accounts and project cost centers, a finance manual or a file of established policies and procedures, and a yearly planning chart. Financial systems design must also cater for the two distinct but interdependent branches of accounting, financial accounting and management accounting. Financial accounting describes the systems and procedures used to keep track of financial and monetary transactions which take place inside an organization. Management accounting takes the data gathered by the financial accounting process, compares the results with a budget, and then analyzes the information for decision-making and control purposes. Financial accounting is a system of recording, classifying, and summarizing information or transactions for various purposes, and accounting records are reconciled and financial data is presented in the form of financial reports. Financial accounting records can be maintained either using a manual or computerized system, or a combination of both methods. The annual financial reports are used primarily for accountability to those external to the organization. The management accounting process takes the data gathered by the financial reports, compares the results against the budget goals, determines reasons for variations, helps to identify corrective action, and analyzes the information for decision-making and control purposes in forecasting and planning. Reports produced by the management accounting process are therefore primarily for internal use. These reports should be produced on a regular basis, usually monthly or quarterly depending on the needs of the organization, and as soon as possible after the reporting period, so that figures are relevant to managers' discussions. Every organization is different. There is no such thing as a model finance system. However, there are a number of considerations to take into account to find the right approach for your organization, such as the structure of the organization. This includes management, number of staff, their functions, and where they are based. The activities of the organization, such as the number and type of projects, the volume and type of financial transactions. Do you pay for your goods and services with cash or with suppliers' accounts or both? Reporting requirements. How often and in what format do financial reports have to be produced for different stakeholders in your organization? Resources of the organization. What financial, equipment and human resources are available to help manage the finances? All of these considerations will help to decide the most appropriate method for keeping accounting records, coding structure for transactions, financial policies, financial reporting routines, use of computers and of administrative staff. Now let's talk about one of the most important steps in establishing your company's accounting system. The chart of accounts will be an important tool for organizing accounting records, financial monitoring, financial planning, and internal control. To illustrate this further, let's think about the many different kinds of financial transactions taking place in an organization. For example, we buy a wide variety of goods and services to help achieve our objectives, from rent for the office to tools for a garden project. And we receive different kinds of income, grants, contracts, and donations, for instance. To make sense of all of this financial activity, it helps to sort the different types of income and expense into a series of predetermined categories or accounts. These accounts are listed in the chart of accounts and are typically arranged in a logical order. Income and expenditure, assets, things we own, and liabilities, things we owe. Then, when a transaction takes place, it is recorded in the books of accounts and categorized according to the guidance held in the chart of accounts. The same categories are used in the organization's budget and financial reports to promote consistency and transparency. Each organization's chart of accounts will be different. Typically, the layout will include an account name, a reference number, and a description for use of the account. Note that the categories are not only sorted by type of account, but can also be sorted into subgroups under family headings, such as administration. Family headings are especially useful for presenting summarized information. The coding method in this case is a numerical system and follows the same logic, using a group of numbers for the same family of items, but alphabetical systems can also be used. Now let's discuss cost centers, another key tool to help get your financial system organized. Cost centers are typically applied to projects, functions, or departments which have their own budget and funding sources. Some grants are given for a specific purpose. These are known as restricted funds because they may only be used for a particular activity rather than for general purposes. Such funds must be accounted for separately so that the organization can demonstrate to the donor how the funds have been utilized. This is known as fund accounting and requires care when setting up accounting systems to identify and separate the necessary information. In such circumstances, it may be appropriate to identify activities within an organization by cost center or activity or budget center. The starting point for deciding on a cost center structure is the organization chart and donor funding agreements. A useful way to graphically present cost centers is in the form of an egg chart. We will use an example of Milestone, a fictional company, to illustrate the concept of cost centers. Milestone has 3 departments: coordination, that is management, administration, and governance, a building department, and a metalwork department. The metalwork department in turn has 2 separate activities with their own funding sources: the furniture project, and the vehicles project. There is no effective limit on the number of cost centers that can be used, especially if a computer accounting system is used. However, it is important to design a cost center structure carefully to prevent record-keeping becoming burdensome and counterproductive. Each cost center should be given a unique reference or code to identify it within the records. With cost centers and chart of accounts in place, when financial transactions are entered into the accounting records, not only are they categorized by the fund, department, or project, but also by the type of income or expenditure. This means that separate financial reports, such as income and expenditure report, can be more easily produced for each cost center, helping managers to monitor their own area of responsibility and report to project owners. As well as identifying the different types of expenditures for your organization, you also need to be able to classify them as either direct or indirect costs. Direct costs are those which are clearly related to a particular activity and can be charged directly to the relevant cost center. For example, in a training project, the costs of room hire for a training event and the trainer's salary. Indirect costs are those which are of a more general nature and relate to the organization as a whole or more than one activity. For example, head office rent, the audit fee, and the chief executive's salary. These usually form the bulk of what are known as the core or overhead or central administration costs. It is important to distinguish between these two types of cost in the accounts so that managers can properly plan, monitor, and control their project resources. In particular, core costs have to be shared out or apportioned between the different projects in a fair and justifiable way. There are various ways to do this. For example, sharing costs according to the size of each project budget. We will discuss this in more detail in the next module, Financial Planning. All organizations need to set down a series of financial policies and procedures to guide operations and avoid misunderstandings. But let's begin with first establishing what a policy is. A policy sets out principles and guidelines for a key area of activity within an organization. It removes any questions about how important resources are used. For example, a vehicle policy will clarify who can drive the organization's vehicles, how they are disposed of, and rule on private usage by staff. Policies are usually written by senior managers and then discussed and agreed by the board or management team. Once approved, a policy is binding on everyone in the organization, and failure to follow through could result in disciplinary action. Policies should also stand the test of time. While it is important to be flexible, organizations should not change policies too often. So what makes a good policy? A good policy should be fair and realistic, cover all situations likely to arise, meet legal requirements, and is affordable for the organization. Now that we have discussed what makes a good policy, let's talk about procedures. What are procedures? Procedures describe the steps for carrying out the guidelines in a policy. They often include a requirement to complete standard forms to gather data and authorization for actions. For example, the vehicles procedure might require completion of vehicle requisition forms and trip log sheets. Policies and procedures are not about being overly bureaucratic. They help to run the organization smoothly and promote consistency, accountability, and transparency. They also facilitate the decentralization process and help managers make the right decisions. Now that you have a better idea of what policies and procedures are, let's learn about developing financial policies. It is important to have a structured approach to developing financial policies to make sure that the policy is fair, realistic, and acceptable to those that will be affected. People are more likely to adhere to policies if they had a say in making them. Decide who will be involved in drawing up the policy. If the policy is to have an impact on how a program is delivered, it makes sense to include program staff in the discussions. Do some background research to gather the information you need to develop the policy. For example, if you are setting a policy on healthcare support for staff, ask around other organizations to see what they offer and what it costs. Write the policy document. Use the following headings as a guide: the purpose of the policy, why we need the policy, who the policy applies to, the policy guidelines, and references to other policies and procedures. And finally, circulate the draft policy for feedback. It is this stage that will check if the policy is fair and realistic, and whether it is likely to be supported and therefore used. Thus far, we have discussed the various strategies for getting organized and the policies and procedures that are needed to guide operations. Now let's take a look at what a finance manual is and why it is important. The finance manual brings the financial policies and procedures all together in one document. The manual may also be known as the Financial Regulations or Finance and Office Procedures. It is generally used by the administrative or accounts staff for day-to-day operations, but also serves as a reference in case of query by program staff. What goes in a finance manual? A finance manual might include sections on financial accounting routines, the chart of accounts and cost center codes, delegated authority rules, for example, who can do what, the budget planning and management process, ordering and purchasing procedures, bank and cash handling procedures, management accounting routines and deadlines, management and control of fixed assets, annual audit arrangements, and how to deal with fraud and other irregularities. The manual may also include some reference materials, such as organization chart and standard forms. It is important to be aware of the limitations of a finance manual. It is a major undertaking and it cannot cover everything, and to do so would be too bureaucratic. It also must be a living manual, used and implemented by everyone and regularly reviewed and updated. The process of developing policies and procedures together is far more important than the finance manual itself. People need to own and implement them rather than see them as a rule book. Now let's take a look at the types of standard forms. Standard forms are purpose-designed documents used to simplify or facilitate financial administration routines. They are one of the best ways to ensure that procedures are followed and understood. Standard forms can be used with almost any procedure, but especially where information needs to be supplied by a third party before a transaction can take place. A transaction requires to be checked and authorized, or financial information is being summarized or reconciled. Some typical uses for standard forms are supplies requisition, payment voucher, petty cash voucher, purchase order, expenses/cash advance claim, travel or field work advance request, fixed assets register, vehicle log sheet, bank reconciliation form, and a journal voucher. One note of caution in the use of standard forms is to not overdo the paperwork, as too much bureaucracy slows down the accounting process and overloads the authorization routines. Financial management involves many different tasks and routines, and therefore it is important to plan tasks involved during the financial year, such as financial accounting routines, for example, month-end and quarter-end reconciliation and payment runs, critical deadlines, for example, payment of government taxes and insurance renewals, reporting schedules, especially to meet donors' reporting requirements, budgeting process, annual reviews, for example, assets register, finance manual and insurance cover, and year-end procedures, for example, closing accounts and annual external audit. One of the best ways to do this is to create a yearly planning chart and put this up in your office and encourage everyone to keep it up to date. This helps to schedule tasks and allocate tasks to staff so that deadlines can be met. You should now have a better understanding and awareness of the organizational tools of financial management. Today, you learned why system design is important, the different types of accounting, tools such as the chart of accounts and project cost centers and their important role in organizing accounts, the different types of costs, the role of policies and procedures, and the importance of maintaining a finance manual. Congratulations! You have reached the end of the module. Please take this time to revisit any of the content we covered today. When you are ready, click the Home button to return to the main menu.